My portfolio is generating over 13% in yield, but that doesn't mean everything in it is working perfectly. Some parts are performing well, some are starting to raise questions, and some positions I'm still not sure about at all. This is Snowball Analytics, and this is my portfolio so far for 2026. As you can see, January I was up 4.37%, February 2.06%. In March, everybody took a hit. I was down 6.4%. Came roaring back in April, up 7.23%. In May, 3.76%. And June has been meh. Slightly down, almost even. And this is the performance of my holdings. As you can see, that's the 1 day. The 7 day, chippy has just been a wagon for me. But it's been chippy. DRI is Darden Foods. That is the parent company of Olive Garden and Longhorn Steakhouse. CPA, which is the Copa Airlines, the Panamanian airline that is doing really well right now. IDVO is the international ETF. JP Morgan Chase. AGNC is a real estate. And QDTE is the high yield yield max. That the index is the NASDAQ 100. That's the 1 month. As you can see, Copa Airlines has been pretty crazy. But as you can see down at the bottom, Main Street Capital, which provides lending to small and medium-sized companies, they've been taking a hit. AGNC has just started coming back because real estate, all that stuff is affected by interest rates. And GDXY, which is the Yield Max Gold Miners ETF, that has been a challenge. 3 month, you can see Chippy has just been on a tear. 6 months, year to date, Chippy has just been insane. Also, MO is Altria. That's basically cigarettes. And I can understand where some people will think it's a sin, that it's not they'll have the ethical questions about the holding. I completely understand where they're coming from. The 1 year Chippy is there. 5 year, that's where JP Morgan was my number one holding up until recently, where Chippy overtook it. But JP Morgan Chase has been a wagon, and that is something that yields less than 2% in dividends. And all time, that's where I'm at there. So in this video, I'm breaking down into the good, the bad, and the uncertain. Let's start with the good. The strongest part of my portfolio has been the shift towards more efficient and more sustainable income. This is my portfolio currently. As of filming today, June 12th, my market value is $54,350.90. My market return, it's been a roller coaster, but you can see my total return is my price appreciation along with my dividends, a nice 23.33%. My dividend yield right now, my portfolio is yielding close to 13% at 12.65. And my dividend growth rate currently is at 9.05. That is my annual dividends received. Annually, I'm scheduled to receive $68.73.26 in dividends. My monthly, my weekly, and my daily, almost a $20 bill daily. One example, as I said, is moving away from all these more aggressive high-yield positions like QDTE and gradually shifting them towards SCHD. The goal here isn't just higher income, it's more stability, better tax efficiency, and long-term dividend growth that I can actually rely on. So I'm going to take you to my positions. Now I have a taxable, which I split between two brokerages, which is Stash and Robinhood. The top part with JP Morgan, Copa Airlines, AbbVie, the Bank of New York Mellon Infrastructure ETF, and Altria. They're all part of Stash. As you can see, Altria is my biggest position there of all of them. JP Morgan does have the highest share price, but here is my total return for them. Right now, JP Morgan Chase has, of that part of my growth portfolio, has the highest total return at 47.32, followed by Copa Airlines, and then Altria, and then Avi, and the Bank of New York, the infrastructure ETF is a newer position. But then as you go into my Robinhood, you can see there that Chippy is just knocking it out of the park currently. That has me concerned a little, just because I don't know how much longer that is going to be on fire like this. But SPYI tracks the S&P 500. That's been pretty strong. SCHD is a position I just recently changed because I took QDTE out of my taxable for tax efficiency. That was my number one income earner, and I put that in my Roth IRA. So now that is collecting dividends tax-free. And now SCHD is going to build, but that's going to build as a taxable account. And as you can see here, I'm going to bring you over to what my scheduled annual dividend income is going to be. You can see that my biggest growth positions are not the best yielders in terms of dividend income. JP Morgan Chase is basically my number 2 income position, but it's only yielding $53.82. Copa Airlines is a good dividend yield, usually yielding between 5 and 6%. Altria is usually doing the same, but then there's big hitters when it comes to my Robinhood portfolio: SPYI, GDXY, and Chippy. Chippy is it's a small position in my portfolio, but it's just been tearing it up. And I'm going to take you to my Roth IRA position. As you can see there, QQQI, that tracks the NASDAQ 100. FDVV is just a straight up growth hybrid income ETF along with SCHD. IDVOC International. Main Street Capital has been a pretty core position to me for a long time. I've held it for a long time. But along with AGNC, it's been affected by interest rates. QDTE is that new position that I just moved into. Over here, I just brought that over from my taxable. So now it's collecting all those big dividends tax-free in my Roth IRA. AGNC is a really good income position. No growth at all. It is actually my 5-year dividend growth rate is actually 0. When I first bought it, it was actually a negative. DRI is the Darden Restaurants. That's the Olive Garden Longhorn Steakhouse. MLPX is an energy infrastructure ETF. And OVL is the overlay large cap equity ETF. That's basically tracking, it basically tracks VOO, which is the S&P 500, and sells puts on that. That's beyond my knowledge, but it actually captures a lot of the upside of the S&P 500 and still gives me a really good dividend yield too. And this is my total return here for those positions. As you can see here, FDVV has been a really strong position. Since I bought it, it's been pretty consistent, followed by DRI, Darden Restaurants. And then AGNC has been a pretty good position. I've only held it for maybe 8 months. And followed by IDVO and QQQI. Some of the other positions, OVL I've only had for 2 months, but it's already given me a total return of 4%. And here's my dividends. As you can see here, my number one earning position is QDTE. That is at $16.08 followed by AGNC at $430. Oh, QQQI is $616.97. AGNC is $430.50, and then QVL at $318.44. See, the part of this portfolio is about building something that doesn't just pay today, but continues paying years from now. And that's the part of the portfolio that's working right now. but not everything is that clean. As you can see in my Roth IRA here, I only have one position that is down currently. That's QDTE, but that's been a position of mine that is doing a job. That is my income position. It's one of them, along with Chippy and GDXY. Maine was pretty strong for a long time, but that has taken a recent hit. MPLX is a new position. And I said the bad part of the portfolio isn't about losses, it's about inefficiencies and positions that don't feel as strong as they once did. Some holdings are starting to feel like they were built for a different phase of my strategy. High yield can look great on paper, but over time, you have to ask whether the structure still makes sense, or it's just producing income at the expense of quality. And that's where I've started to rethink parts of my portfolio setup. Which brings me back to, so these are the parts that I clearly see, the good and the parts I need to fix. But the hardest decisions aren't the obvious ones. They're the ones I haven't answered yet. And that's where things get uncertain. The uncertainty is here, GDXY, which is my UMax Gold Miners Option Income Strategy ETF. Holding 174.01 shares. Right now, the market return is down $805.67. My total return is still down $199.10. As you can see, that's my market return, down close to 30%. But with the dividends, it has brought it back to just being down 7.35. And I'll show you this. That's the dividend yield. Recently, I did a video on how my 72% dividend yield position was losing me money. Now that same dividend is paying 76% and it's still losing me money. That's it there. As you can see, it's down significantly, but look at where my projected income is. It's almost $1,400 a year. So the first is GDXY, whether it still fits the role I originally intended it for it, or does that position need to change? And the second is a bigger, more general question I've been asking myself. Where do more speculative, easy for me to say, high growth ideas fit into a portfolio like this? Not just for me, but for different types of investors at different stages. Because what makes sense for someone early in their investing journey may not make sense for someone focused on income and long-term stability. And that's the question I'm going to keep exploring in the next videos. Because building a portfolio isn't just about what works today. I started late into this game. I started in my late 50s. I went through decades thinking that a 401k alone was going to handle what a retirement was going to do. And it took me that long to realize that it wasn't. So I started investing in August of 2022, and this is the portfolio I've built since then. So it isn't about what works today. It's about understanding what still fits tomorrow. And in my next video, I'm going to go over one of these things that is starting to come at me. Something about something more speculative, more high growth, and whether that fits my portfolio. But if you stick around, I will go over what happens when a high yield position is bringing in a lot of income and is still down, but I ignored a position that wasn't all about dividends, but was performing better than all the rest of them. So stick around for that video, and until the next time.